How does a fix and flip loan work? By the end of this episode, you're going to know exactly how a fix and flip loan works, and more importantly, where to get the money. So something to think about on lending or when dealing with a lender. A lender, how do they make money? They make money by lending money. They want to lend you money. So the things that we're going to go over is how it works, but also how to attract these lenders as well. How to make sure that people want to lend you money. So we're going to go through that as well. So let's get started. So the biggest thing I tell investors when working with them is you want to understand and know the process. You have to be able to identify the right property. So put yourself in the lender's headspace or what they're looking for. They're looking for someone that has a good deal first, right? And knows what they're doing, right? Knows how to present it. So if you have a bad deal, they're probably not going to lend to you, and it doesn't matter how it works anyways. But let's just go through what goes through the lender's mind and how that works, right? So identifying a property, you want to make sure that you have a property under contract that is below market value. You want to be able to factor things in, such as your rehab cost and the ARV, after repair value, which then you could create your margin from there. Like, how much money do you want to make? And then you could back into what your offer would be or what you're buying the house for. These are things that the lender is going to look for when giving you a loan. And sometimes the better the deal you could create and articulate, the better the deal they're going to give you. Okay, so they're going to base the loan based on how good of a deal you have, essentially, or how good of an investor you are. So if you're new, you want to make sure you have a much stronger deal and are able to articulate it. So one of the things that a lender, typically a private or hard money lender, they're going to be looking at your strategy. And what is your strategy for this property? And in order to get a loan, you've got to have the strategy. So let's go through these parts. You need to determine what needs to be done to the property when you're evaluating it, and what are your rehab costs. You get this from a general contractor, or the more that you do this process, you'll be able to articulate and put that on an Excel sheet and determine that. You'll also want to, when determining your fees, like the rehab costs, you also want to factor in their fees. You want to factor in what's your holding cost. What does that mean? Holding cost is how long you're going to have the property, so that you need to look at different things on the market, days on market, and what is your rehab time frame. So let's say it takes you 3 months to rehab the property and another 2 months maybe time on market. So you have to factor in at least 5 months of interest payments on those. You also need to factor in your points or any other fees that are associated with it as well. Because with the lender, one of the things how that works is when they're lending to you, they have a premium, typically interest, or higher interest rate than normal. Why is that? Because they're taking on some of the risk by lending to you, and it's a shorter period of time, and who knows what happens. Maybe they end up with the property midway through the flip, so they have to factor all these things in. So when doing this, they're looking at what needs to be done along with the LTV, loan to value, or what they end up lending you on typically is loan to cost, the cost of what you're buying the property for, and then they factor in maybe it's 70, 75, or 80%. In an aggressive market, they'll lend up to 90%. And then typically you could ask for the rehab money as well. So let's just say you bought a house for $400,000 and it's going to cost you $50,000 to rehab it. They'll lend you the $400,000, and then as time goes on, as you hit milestones, they'll lend you that additional $50,000 over time, or maybe it's over 3 or 4. They call them draws. Okay, so you take a draw at each milestone as you finish a project or a portion of that project. So prior to even getting the loan, you have to submit a package that shows what needs to be done to the property. All those different items have dollars associated with them. That's the approved, let's say that 50,000 once it's approved. And as you finish those milestones or projects, those costs associated with those get reimbursed back to you. So let's say, for example, you put in new windows and doors and that was a $4,000 item. Well, once you're finished with those, they'll have an inspector come out, and if those are all done, they'll document it and you get that $4,000 back to continue moving forward on the project. Something to think about when looking at different lenders and how these things work. So different lenders there's different ways that they could set this up. So you have interest rate that varies. You could have a hard money or private money loan as little as 7.5% or 7, whatever, up to 19% depending on the lender. You also could vary in LTV, loan to value, or loan to cost, what you're acquiring the property for. It could be as low as 65% and as high as 90% of what you're buying it for. So these are things that you want to pay attention to. Also, you want to look for prepayment penalties. I try to avoid the prepayment penalties, but some lenders are just looking for that accrued interest over a period of time. So oftentimes I'll see people with a year-long prepayment penalties. So that means you'll need to factor that into your loan if that's your only option, and does it still pencil? These are key things before you sign a note. You want to make sure that these are things that you've fleshed out, because if you're at 15 or even that 19% over a year and you have a prepayment penalty, you have to pay that. Even if you did flip that house the very next day, you still owe that year's worth of interest. So make sure that you're calculating these things and taking them into consideration when getting a loan with a private or hard money lender. If you're liking and finding this video useful, give us a thumbs up below. So when they're lending you money, oftentimes you have to make, in most cases, at least my experiences, you have to make monthly payments of that interest to that lender, right? So if you have a $3,000 a month interest only payment to that lender, well, you owe that every single month and it's due on whatever date that you agree on. But sometimes they'll go ahead and include it in the original note and you just owe that all at the end when you pay it off. I haven't experienced that personally, but that's also another way for you guys to go, and it actually could make the job go a little bit smoother as far as freeing up cash flow for you. So just make sure if you got those, check all the other boxes and see what works best for you. So on a fix and flip loan, sometimes I tell people, hey, have multiple exit strategies. Okay, so when you go and sell this property, yes, you would obviously pay off that note to that lender. So let's say you decide to keep it. You could also refinance that and bring that interest rate down, making that a payment much more affordable. And sometimes I've done this where the market's changed and rents are going up so much, I've decided to keep the property, pay off the fix and flip loan, put a long-term debt on it, which is a long-term loan, traditional, at a much, much, much lower rate. And typically my value obviously has gone way up. So I'm getting really good rates and really good terms. Just something to think about. But ultimately, you either pay them off by refinancing or obviously once you sell the property. Whether it's a fix and flip loan or any other type of loan, click on the description below. We're going to give you access to any type of real estate loan that you could think of. Just click on the link below.